Okay. One second. All right. Okay, good morning, everybody. I'd like to welcome you all to the Daily Energy Markets podcast. It's Friday, November the 24th. I'm delighted to be joined by Anish Kapadia, Director and Head of Energy at Policy Advisors, Max Torres, Managing Partner at Plata Energy, and Mark Howson, Head of Asia for Welligence Analytics. Thanks so much for joining us, gentlemen. It's great to see you all again. It's been a while, for me at least. Anish, let me go to you first for an overview of, and perhaps a comment from you on how you're interpreting what we're seeing as a potential sort of OPEC plus discord or sort of lack of ability to perhaps know what's next steps will be, given they've postponed their meeting. We don't know why, but consensus that there's now this debate of, well, how long can Saudi continue to be the only one supporting cuts, etc. Do you think that is an issue, and how could it be resolved?
Good morning. So our view at Palissy is that we've been quite bearish on the oil market in general over the course of this year. We've got a $64 WTI target for crude, and we expect it to be hit again in the coming months. And the reasons behind that are both supply driven and demand driven. So we've seen a lot of supply come onto the market that I think the market didn't anticipate from what we call the sanctioned countries, the likes of Venezuela, Iran, and Russia. And we see a substantial amount of crude coming back onto the market. If you look at September over the next kind of 6 months, we see about 900,000 barrels a day of incremental supply from the likes of Iran, from Venezuela, from some of the more established countries like Brazil and Norway coming back as well. So there's a lot of supply coming onto the market. And we see demand as pretty weak. Demand has been good this year, but looking forwards, both in the OECD and non-OECD, demand doesn't look great. So with that backdrop, despite the numbers that OPEC put out of there being an oversupplied market, I think the reality on the ground is there's too much crude sloshing around, and OPEC need to do something about that. So that I think that's what's caused this difficulty at the moment. Saudi and the others are thinking about them needing actual further cuts. And that's where the difficulties and the disputes are coming to pass.
Okay, thanks very much, Annie, for that. Max, let me go to you then on that. Venezuela, one of the countries in Latin America, is obviously expected to, and is already showing improvements, obviously, comparison to a few years ago. Of course, we had the relief there in terms of US sanctions for a while at least, and allowing more of that oil to exit. But Max, from Venezuela's point of view, do you think that's just only fair? Countries like Iran and Venezuela ability to export all the oil they can now, they're being able to do more so OPEC should be taking the brunt. And give us your take on where you see Venezuelan production going.
Thank you, Alan. Excellent question. Venezuela really production is in a deep low. Right now, it should be something like 600,000 or 700,000 barrels, which is a very, very small number compared to the 3.5 million or 4 million that they used to produce, back in 2000. But going back to your question, I think it's going to be a while until we see a real comeback of the Venezuelan production. They lack the infrastructure, they lack the investment, and they lack the companies, to actually, increase the production. The lifting of the sanctions, that was October this year. It's been a few months. We are seeing some signs, of companies signing deals. Shell recently signed a deal, it's a gas deal with Trinidad, with the government of Trinidad. But and then Chevron, is going back in country. But it's going to be a while. It's going to be a while until we really see Venezuela making a difference. I think the lifting of the sanction is related to probably the instability of the situation in the Middle East. From the U.S. point of view, they need some other, source of reliable near production. But then again, it's all politics related. Next year, we're going to probably see, we're going to have elections, and we're going to see probably changing political signs. So, who knows? My take here is that Venezuela is going to be a few years until we see a difference, really.
Okay, even if that sort of 6-month, let's say, sanctions relief is extended, it's still going to take time for also for those investment dollars, I suppose, to come back in and attract more companies. Mark, morning again. Let's talk a bit about gas, and in the context of Asia and Europe. We're coming up to winter now. This time a year ago, there was a cost of living crisis in the UK. Europe wasn't doing too well. We had major panic still about what gas supplies is Europe going to be able to rely on. 1 year on now, everything's looking much more settled, isn't it?
That's exactly right, Diala, and it's certainly one of the key questions that the clients are asking us about how we do see it to pan out. So just to give you a bit of history on the last 12 months, of course, we had European LNG deliveries shoot up very dramatically towards the end of last year. And in combination with the relatively mild winter we had in Europe, European gas inventories are now pretty much full in their entirety. So that, of course, is keeping a cap on prices at the moment. Gas prices into Europe and trading for December are just over $14 and just over $16 into Asia. They have crept up in the last couple of months, partly due to some of the uncertainties around Egyptian supplies in the Middle East, and also because, like you quite rightly say, we're heading into the winter months. So we have seen imports actually increase month on month by a couple of percent, both in the European Union, but also in China in the last couple of months as well. However, what to me is very interesting is if you look at European LNG imports this year versus last year, we've actually come down by a couple of percent, predominantly because inventories are so full. However, with China, it's a very different story. Chinese LNG imports are up 11% year on year because, of course, the economy there is improving on the back of the COVID-related sanctions and restrictions being eased. And also with the lower prices this year, gas is more able to compete against coal in the energy mix. So we're seeing more of a move back to the traditional LNG pattern, whereby Asia very much drives the demand, and Europe followed. Of course, last year was the exception because of the Russian pipe gas cuts earlier in the year.
Yeah, absolutely. Last year, Europe had the upper hand. It could afford, I suppose, that more expensive LNG. And much is weather related. We'll see what happens. But inventories certainly look healthier this year all round, including oil. Anish, back to oil. Let's talk about demand again. I mean, yes, you're saying that this year's demand was quite strong. We haven't seen those recessions hit the US, sort of shallow recession. Europe's not had a great year, but not bad, all things considered. People are saying that 2024 is when we're going to feel, this trickle effect of the macro policy we've seen on interest rates, etc. But I mean, demand in China, for example, Anish, has not been bad this year. It's been pretty robust, despite the talk of, it's not met expectations, but it continues to be the sort of support, doesn't it, for oil prices? But what do you see materializing as we go into next year there in terms of sentiment? How much support China can provide?
Yeah, so when we look in terms of total oil demand for 2024, we actually see weaker oil demand in 2024 year over year, and that's both on the back of weaker demand in the OECD. So when you look at the US, actually, if you look at the US over a long-term period, there's been no demand growth in the US, and we think that the weaker economy means that actually you'll see slightly weaker demand. When you look at the real-time indicators, which we think are more important to look at than in terms of the data, it doesn't look great, both in terms of gasoline and in terms of diesel in the US. The European economy, you're clearly seeing an economy that's struggling. You see that on the gas side and on the oil side. So we think you're going to see continued weakness in Europe. But yeah, China, I think, is one of the key markets. Obviously, it's been the key market for growth when you look back over the last decade. Our view on China is that you are going to see actually weaker demand from China in 2024. And again, that's looking at the measures that China is putting in and the state of the economy at the moment. So the credit impulse hasn't really come through in China, and we don't expect any significant stimulus to come through. We don't think that that China wants to overinflate the economy. And you're also seeing signs from you have had some strong growth this year, but I think China will be quite price sensitive as well. That China is sitting on a huge stockpile of inventories, both crude and products, which the market doesn't really look at that closely. But it's got plenty of inventory that it's built up when prices are low. And if you do see prices creeping back up again, we think there's a significant risk of China destocking both on the crude and the product side.
What about the rest of Asia, though, in terms of their inventory and obviously the sensitivity to dollar as well, and the expensive sort of dollar-priced oil? How's the rest of Asia doing?
Well, I'd say the other key market in terms of demand from Asia is India. And again, India has had a strong year this year, but the most recent data that we're seeing, the real-time data, is showing that India's slowing down somewhat as well in terms of its oil product demand. So I think that's an additional risk that you see some slowdown in India. Those two markets are really the key drivers, or have been the key drivers of oil demand growth. So I think those are the ones to keep a watchful eye on. But our view overall is that you're going to see weaker demand weaker than expected demand, definitely, than what people are expecting.
Okay, Max, we have an article here on the bulletin today which says that China cuts back on Venezuela oil purchases after US sanctions relief, playing the political game, if you like. I mean, should we read much into that? A lot of Iranian oil has been going to China. What do you think that means?
I think that's twofold. One is China trying to play its game, putting some pressure into Venezuela. How they're going to play with the lifting of the sanctions. Obviously, China has ambitions over Latin America in general. They've been very strong in many countries. So that's one way of putting pressure into Venezuela. That's one thing. And then the second thing is what you said. I mean, basically, they have other, suppliers. They have, cheap oil from Russia. They have Iran. They have other suppliers. So I guess they are playing this card as well. But from the Latin American perspective, I think it's just, putting pressure into Venezuela, how they're going to play. Obviously, Venezuela has a huge debt with the Chinese and the Iranians and the Russians. So basically, they need to think about how they're going to play the lifting of the sanctions.
Okay, and
bringing the U.S. capital in, or privatization, or whatever they're thinking, ahead.
Okay, and are you, Max? Just staying with you, are you as bullish, as others are? I mean, Anish mentioned Brazil, more non-OPEC supply coming online this year. What's the latest with Mexico, Brazil in terms of 2024 supply? We had two quite varying expectations from commentators last week. One saying that they expect non-OPEC supply will continue as it has this year in terms of growth of supply. Another one told us they think it's going to halve next year. So we've got quite sort of diverse expectations out there for non-OPEC supply. What's your view on the rest of the LATAM region?
I think Brazil could be, increasing some production. There are some of the projects, coming online. Guyana is another area that is going to bring some supply. Exxon is bringing more FPSOs into the region. So Guyana is going to see 24, 25. We're going to see a significant increase in supply. Mexico, I don't see anything happening in Mexico. There's some issues with contracts and government, and some of the companies are basically pulling out of the country. There have been some new discoveries, one by Eni recently. But I think Mexico's will be put on hold, because of the situation with the government and how they're going to handle the new contracts. But I see increase in Guyana, and I see increase in Brazil for next year and 25.
Okay. Mark, just back to
maybe Argentina. Argentina, we just had elections yesterday or Sunday. So maybe we're going to see some changes in Argentina 24, 25 as well from Vaca Muerta.
Okay. So that's kind of the outlook for the next 2 to 3 years. Mark, just back to LNG, but talking a bit more about infrastructure. Obviously we saw that Europe last year, not only was it scrambling for spot cargoes, but it also started to invest in beefing up its infrastructure as a sort of long-term view of weaning itself off Russia. Are we seeing continued commitment to that? And, how much security do you think that's providing? And how is it going to impact spot versus term purchases going forward?
You're right, Diala, to highlight that, because it was quite extraordinary last year. Within 9 months of Germany, and that's the best example, saying that they need LNG import infrastructure, they managed to start up an FSRU, so that's a floating storage and regasification unit in their country before the end of the year, and they've now got several in place, and they've also got several more lined up as well. There are other countries as well, particularly in Asia, that have also harnessed FSRUs, because of course FSRUs can move into place very quickly and allow quick imports. The world's largest actually started up this summer in Hong Kong, but also Philippines has adopted them as well. The other big advantage of FSRUs is that they are a much lower capex, and if a country does either reduce their gas demand, like Europe is eventually planning to even further, or if that country discovers more natural gas on their own upstream sector, that FSRU can kind of go off and go somewhere else in the world. So they also offer a very flexible import option as well. On the supply side, Diala, we're seeing an increased use of floating LNG terminals as well. They're much quicker to get into place, and they're less capex, because you can just convert an existing facility into a floating LNG unit. And actually, if you look at the new supply coming on stream next year, whether it's particularly focused on West Africa, a lot of that will come from floating LNG facilities as well. So I guess quicker, lower capex, more flexible infrastructure, which also has the advantage that it is lower CO2, lower carbon intensity, because of course a lot of these vessels are actually conversions from existing LNG carriers. So you're not having to build an entire piece of infrastructure from scratch, or in the case of an onshore facility, do a lot of site clearing on land. So yeah, increasingly adopted, and it just allows players to bring volumes in quicker for their energy security of supply. Now, a related but different point is the one you touched on regarding what the balance is likely to be between spot short-term purchases versus long-term contracts. Now, the amount of spot and short-term, very short-term, under 2 years, LNG deals peaked at 40% of the market in 2020, because, of course, the market was very oversupplied and LNG prices were under $2. However, since then, we've seen a real snap back to long-term contracts, particularly out of Qatar. And in the last 12 months, we've seen 5 long-term contracts from the Qataris. The two kind of most famous ones were to Sinopec in China, and these were very much 27-year deals. So the longest deals we've ever seen in the LNG business. But in addition to China, 3 European players, Shell, Total, and Eni, then also signed these 27-year deals as well. So a real move back to long-term contracting. Yeah. As opposed to just relying on spot.
We had somebody on yesterday who was saying that they were quite surprised that these long-term 20 plus years, that takes us beyond the 2050, or takes us up to the 2050 net zero pledge date, and yet we're still committing ourselves to buy gas that far forward, which is interesting.
And I think we always expected that in Asia, but to me what was very interesting when Total, Eni and Shell signed those deals for delivery into Europe for 27 years, because like you say, that raises questions with net zero commitments.
It doesn't bode well for some of those discussions that are coming up at COP next week here in the UAE in terms of the industry's commitment. We have that survey question up there for today, which is an oil price forecast. What do we think Brent will be at the end of the year? Closer to which one of those? 90, 85, 80, 75. We've been drifting down, of course, from 90 for the last few weeks. So we'll see what our pundits say in a few minutes on that. Anish, back to you. Just again, back to sort of supply, OPEC. The Saudis seem to be now coming under a bit of pressure. I mean, they've got all these expenses. Obviously, they've got a huge, diversification expenditure program. Do you feel that they would be willing to cut? I mean, the expectation is they may cut more. That's kind of also could be a problem because that kind of does then leave them obviously with more capacity, and that obviously brings prices down as well in terms of sentiment. So, what position do you think Saudi is going to take at this meeting now coming up next week?
So I think when you look at Saudi and think about Saudi, the oil price that's required to balance the budget, I think, is irrelevant on a short-term basis. Over a 5-10 year basis, it becomes more important. But they've got they've got such vast resources that it's not a big issue, and they're also diversifying the economy, and this is one of the reasons for that as well. So I don't think they're that focused on price, or as focused on price that people think. They're focused on inventories and inventory levels. If they see inventories starting to rise or starting to balloon, as the case may be in 2024, then they're going to want to take action. I think that's why they took preemptive action over the last few months, because they did see inventories rising. Despite the numbers that come out of OPEC showing that it's an undersupplied market, I think they actually believe that it's an oversupplied market, or there's an oversupplied market coming. So their view suggests that further cuts are needed. And now it's a case of them saying to the others, well, we've done our bit, you have to come in and participate. And I think it's particularly stark with the African nations, the likes of Nigeria, Angola, where they've got pretty substantial quotas, but they're nowhere close to those quotas due to the declines that have come through on many of those oil fields. So that's why the conversation is shifting to some of the other countries to say, right, you need to bring those quotas down if you're not going to be able to produce at those levels, and you're going to then have to share in some of those cuts in 2024.
Yeah, but they don't seem to indicate they're willing to adjust those quotas on paper, are they? I mean, I know they're not meeting them, but that would be giving up quite a bit. And then on the other side of it, the other producers who could cut, like the UAE, Kuwait, the bigger ones, also would be pretty reluctant, given their focus has been to build up their capacity. Yeah,
and I think that's probably one of the reasons behind the postponement of the meeting, is that I think there's a push to cut from the bigger producers, the likes of Saudi, UAE. UAE is one that wants to get an increase in its quotas. It's got a substantial amount of extra capacity that's being added, and it probably deserves an increase to its quota. So there's obviously a lot of different there's a lot of tensions between the different producers, and it's not helped. I'd say one of the key things that has surprised OPEC this year has been the countries such as Venezuela, Iran, and Russia all continuing to produce or surprise to the upside in terms of production. So those countries that are exempt from the sanctions have continued to increase production. And again, it feels like there's going to be more production coming out of those countries. Iran has surprised to the upside and will continue to increase. And Venezuela, you have seen some increases come through, and there is the potential for substantial increases, maybe not in the short term, but over the next couple of years.
Yeah, I mean, we have a couple of bulletin headlines there today, which kind of indicate the US is getting a bit stricter on its sanctions, whether it's on Russian oil flows or even on UAE tightens scrutiny on Russian firms here because of pressure from the US. So the US seems to be sort of getting its stick out a little bit, but I don't know if that's making any difference to sentiment in the market in terms of the future of Russian oil flow and indeed revenues. Most people seem to think that's just going to continue to make it somewhere. Max, let me get your viewpoint. We've got COP28 coming up here, being hosted in the UAE at the end of this month, starting. What is the view from Latin America and the countries there on their attendance in terms of expectation? And what would you say from that part of the developing world would be a priority to get out of this meeting?
Well, the transition has been taken by some, NOCs companies. Basically, those are the companies who are the front runners on transition and clean energy. I will mention probably, Ecopetrol, Petrobras, some of the other NOCs, which are the larger companies in Latin America. Most of the majors here in Latin America are gone. Basically the NOCs are the significant players. Probably those companies are the ones who are going to have some expectations, in the discussions on transition and clean energy for the the next decade. Let me point out that the transition issue here as a whole, is not a major point, since as we all know that Latin America is not producing a lot of CO2 or emissions. These days, since most of the region is undeveloped. So that is not a significant issue, in most of the discussions in the business world in Latin America. Nevertheless, as I just mentioned, there are some front runners, which are the NOCs, that probably they're going to be making participation in the conference and expecting some answers, coming back, mostly because they have some political input into their, daily lives. So they need to have some answers, for the politicians, not from the business sake, but more from the political end of the discussion.
Well, certainly, I mean, because it's being hosted also in the UAE, the industry is being welcomed into the discussion much more so than previous COP meetings. So it'll be interesting to see what angle or outcome that produces. Mark, let's just go back to you, talk about Russia again, but gas. Obviously that's kind of been off the radar since Russia began to cut off its supplies here and there to Europe in principle and mostly. Any expectations we'll see anything different next year? Will Russia have to start releasing a bit more of its gas if it can for revenue purposes? What are the expectations there?
Well, the interesting thing about that, Diala, is, like you say, piped gas supplies into Europe have certainly almost entirely dropped off. But very interestingly, LNG deliveries into Europe are actually very buoyant and still very much growing from Russia. So, we expect that to continue, unless, of course, there's a political change, particularly on the European side, to kind of impose sanctions on the LNG deliveries. And I guess Europe is now in a stronger position to do that than last year, primarily because their gas storage levels are so much more full. Still, however, we do expect the LNG market to be tight in 2024 and 2025, just because there's very little new supply coming on stream. So the Europeans may want to wait until around 2026 before, trying to avoid usage of Russian LNG, just because the market is expected to be tight. So that if there's a particularly cold winter snap, there may be a drain of resources that may endanger energy security there, particularly gas security.
What about Australian LNG, Mark, in terms of what's been happening there with some of the M&A activities, some of the closures?
Yes. Sadly, Australia isn't actually expecting big growth in their LNG supply. They are one of the world's 3 biggest suppliers at the moment, with about 80 million tons per annum of supply. However, a combination of resources that are kind of quite far offshore, tricky to monetize. They're also quite short of gas, particularly on their eastern coast, means that there's just not as much available gas to export, unlike a Qatar, which has obviously got a far smaller domestic population, or a United States, which has had the huge unconventional gas revolution, and they've got more than enough to export. Australia is a bit more supply constrained, and sadly it's a higher cost environment as well, with some additional taxes and trade union militancy increasing as well. So not the focus for LNG supply investment for the next few years. There's just one train that is under construction. It's an expansion of the Pluto project, the Woodside project. But aside from that, the outlook's pretty uncertain.
Okay, thanks, Mark. Anish, I'll just go to you to wrap up and look at that result of that survey. Where did you let us know what you think is where the price is going to end up at the end of the year? That seems to be pretty evenly spread out there, doesn't it? But sort of 85-ish seems to me the midpoint, which is obviously higher than we are today. What's your feeling on that?
Yeah, our view is going to be sub 75 by year end, or around that kind of period, and that's that's really on the back of a combination of OPEC needing to cut more, or there being more spare capacity available on the market. You just think that the market is actually oversupplied at the moment.
And then, I mean, we have people saying it's going to drop before it goes up again, but once it hits those lows, we're going to see some traders, obviously, who have placed that expectation probably in their books as well, do see, because of inflation, because that's still around next year, etc., that these prices are going to recover, even on the technical side, regardless of what we see on fundamental demand.
I think at the end of the day, fundamentals play through, and so we think the oil price is going to stay low for a while with that oversupply that's in the market. I think ample inventories when you look outside of the OECD, and demand staying quite weak. So that when you look at that in conjunction with the ability of the lack of ability for OPEC to cut that much further, I think will keep oil markets weak.
All right, thanks very much, Anish. Thank you to Mark as well, and Max, for joining us today. Have a great day, everybody, and a good weekend. All the best.
Thank you, Dala.
Dala.
Thanks.